evening and welcome to the Money Show, your trusted guide to making smarter financial decisions and navigating the world of money with confidence. I'm Kavita Thapliyal, and whether you're a seasoned investor, working professional or just starting your financial journey, we've got something for everyone. Today's episode is all about decoding the financial headlines, exploring smart investment strategies and giving you actionable insights to grow, protect and manage your wealth, from inflation trends to market movements, tax tips to digital banking. We break it all down, simplify it for you and give you clarity. So grab your notepad or your finance app, because it's time to take charge of your money. And this is the Money Show. We are just getting started, and on this show, we also answer your portfolio queries. So just in case you have anything related to any financial goal that you want to ask, or need help from our experts to strategize it for you, we have you covered. All you have to do is just send across your questions on our WhatsApp number, which is 865-797-4571. The email ID is themoneyshow@etnow.tv. So in the last leg of this show, we'll be answering your portfolio related queries. But then, let's begin. And now, as we navigate the dynamic world of markets and investment, it's time for a deeper discussion on the trends, opportunities, strategies that could shape your financial future. To guide us through this conversation, we're excited to welcome Rahul Singh, CI Equities from Tata AMC. And today we'll be diving into key factors driving market movements and the impact of global economic shifts and how investors can position themselves in the current climate, from market volatility to long-term growth. Rahul will share his perspective on where opportunities lie and what strategies can help secure a better financial future. Rahul, thank you so much for joining in, and today we'll be hearing your insights on the market movement. And since we have you in the beginning of the week today, and we've seen what a volatile session we have today in the market as well, but then I would just like to take you back to Jan. And then again, in past 6 months of this calendar year, we saw a phase of extreme uncertainty. And then there was a time where we also felt the market is directionless. And again, now we are seeing problems in the Middle East. If I have to compare the last 6 months, markets in Jan to markets in now, where are we exactly?
Yeah, hi. Good evening, and thank you for inviting me. I think the markets are basically fluctuating or oscillating between geopolitical risks as well as economic risks. So if you look at the beginning of the year, when the fears of trade war started, I think the economic risks were dominating, because it was not clear what kind of impact it will have on the GDP growth rate, not just for US, but for other countries, for the developed markets, for the emerging markets, for the exporting economies. So I think economic risks were dominating the discussion in the initial part of the year. And subsequently, I think the geopolitical risks have taken over, while the economic risks have actually come down. Because if you look at the discussion around the trade war, a lot of climb down has happened on part of the US, and also there seems to be a good possibility that there would be a decent trade deal which could be struck between, especially between US and China. So I think the economic risks have come down clearly, but the geopolitical risks continue to be high and have gone even higher in the last 1 week or so. And it's also more relevant for Indian markets, because the geopolitical risks, any geopolitical risk in the Middle East, is particularly important from India's perspective, because we are a net importing economy in terms of crude, and therefore any impact on crude prices due to tensions in the Middle East has much more impact on the Indian economy than any other emerging market. So to that extent, we are much more vulnerable as a market, as an emerging market, to what happens to crude prices as compared to the other emerging markets. So while in the first part, when the economic risks were dominating, India was relatively insulated, and we saw that Indian markets were actually performing better, much better than the rest of the global markets, including US and other emerging markets in China. But in the scenario where crude prices continue to go up or risk going up, there would be a risk of underperformance for India if it continues like this.
All right. Rahul, that's very well explained, and definitely we are more vulnerable as compared to the other markets as well. But I also want you to explain the translation in FII's inflow now? What's going to be the fear on that end for us?
So FII inflows are right now, if you look at the top-down view on FII inflows, I think one thing is very clear that US has become a highly owned asset class over the last 10 years. And to that extent, there is a little bit of diversion which is happening away from US into gold and emerging markets. And India is a significant portion of emerging markets. To that extent, India will benefit. So, as I mentioned earlier, I think the overall macro scenario from a shift away from US dollar towards emerging markets and gold is positive for emerging markets and also for India. But I think what's happening really in the second level or the second layer is the fact that there is India specific impact of crude prices, which I think has happened only in the last 1 week. So we need to wait and see how deep or how long the impact of this geopolitical situation in Middle East is. So as far as now is concerned, I don't see too much of an impact on Indian FPI inflows because of the geopolitical event, because the overall environment remains more favorable for emerging markets than it has been in the last 5-10 years.
Uh, Rahul, how also do we look at our quarter results? Now, what sense, how do you like the earnings growth in the last quarter, and what are your expectations from the new financial year first quarter now?
Yeah, so I think in the last quarter, the earning estimates were not cut materially. So it was a quarter where after a gap of 2-3 quarters, it was probably a quarter where the impact on the earning estimates was relatively less. So to that extent, it is kind of a consolidation quarter, if I can call it that. What we do really need is a fiscal 26, 25, 26 to really show growth. Because if you look at fiscal 25, FY25 as a whole, we've had a pretty disappointing year in terms of earnings, where the earnings have grown in low to mid single digits. I'm talking about Nifty 50. And what we really need is a bounce back of this growth going forward. And to that extent, I think last quarter results indicate that there is some stability now, or let me put it the other way. I mean, the earning estimates which have been cut, I think they are not getting cut any further. So to that extent, it's a good first sign. But what we really need to see is what's going to happen in the next 12 months. The initial signs are with the liquidity push and the monetary policy being favorable, and the personal income tax cut and the government spending being much more uniform. Chances are quite decent that we will have an earnings growth rate this year, which is better than last year, much better than last year. So to that extent, I think that's a positive sign.
Sure. Let's talk about sectors, Rahul, now, and talk about themes which you think will be dominating now going ahead. And okay, in terms of valuation, also maybe you just might want to rope that answer in. Sectors right now on your radar, and sectors that you think are really overvalued and as a theme might not work going ahead for a couple of months.
Yeah, good question. Actually, we have to now identify a new set of sectors where the expectations are low, valuations are low, and things are turning around. I think banking, BFSI in general, which is banking, insurance, and BFCs, is definitely one such pocket where there's been a complete U-turn in the macros from a very tight liquidity scenario of last year and high funding costs. We are entering into a period where the liquidity situation is eased. So that's generally good for the entire sector. And with the monetary policy being very, very pro-growth oriented, I think that is one sector which is still looking decent, although there's been a little bit of a kind of catch-up rally which has happened in that sector. Still, the valuations are quite reasonable, and not just in banks, but across the whole BFSI space, I would say. The other sectors where the expectation remains low are cement, where there has been pressure on profitability last year. Similarly, on the consumption side, I think the recovery or the demand growth was not been there in large parts of consumption. And on both these sectors, we are seeing early encouraging signs that profitability this year and the growth this year will be better than last 2 years. So these are the other two sectors I would highlight. And the other sector which looks interesting from a long-term perspective is the healthcare sector, not pharma, but the healthcare sector, which is hospitals and diagnostics, because it's not just a defensive, given that it is very insulated with to the economic cycles, but also the fact that I think the fundamentals have improved, the pricing environment has improved, and there always was and there still remains a very long-term sustainable demand supply gap, which will help the sector over the next 5 years.
I want to focus on consumer discretionaries. Now, this segment, what part of this segment is exciting for you, and what parts of this segment are lull?
Well, I think consumer discretionary is a large segment. It's a very wide selection of sectors. So, for example, if you look at luxury, tourism, travel, that never got impacted by, even though that's part of discretionary demand, that never got impacted. In fact, that was growing very, very well in the last 2 years. And I think now it's sitting on a high base. It'll be tough to see significant growth or material growth from those sectors. And also the valuations there have become rich, so one needs to be a little careful. When you look at the lower ticket items, which includes your your white goods or your QSR or your urban retail, those are the segments where the expectations are low. The valuations have corrected, and any pickup in demand there would lead to valuation improvements incrementally and also earning upgrades. And that is where I think the probability of creating an alpha or generating an outperformance from these sectors is now at a pretty good level, I would say.
Sure. I also want to understand in terms of market caps. Now, do you think it's that time where you should be betting more on large caps? Obviously, a tactical and a strategical placement in your portfolio as far as mid caps and small cap is concerned is important for investors. But do you think one should be banking more on large caps to sort of, just move away from the volatility?
Yes, I think so, but not just because of volatility. I think growth is also becoming a little challenging, especially in the mid-cap sector. I think small cap, the valuations are still reasonable compared to the mid-caps. And I think some of the large cap sectors are looking more attractive, not just in valuation, because just valuation is not enough. We also need to see signs of growth. So, for example, I was mentioning about BFSI sector. A large part of BFSI is a large cap, and that's the sector which is turning around in terms of growth expectations, and valuations are still reasonable. It just so happens that it's a large cap sector. So I think the idea should be to identify these pockets of sectors or companies where expectations are low, valuations are low, and you are seeing signs of a turnaround. Whether it's a large cap, mid cap, or small cap is a secondary issue in my view.
One last question to you, Rahul, and then we'll wrap up this discussion. I know that we have to talk about equities, but then having said that, I also want to understand from you, being an equity CIO, how much of a thrust to gold? Is this year now henceforth going to be a gold year? How will you help our viewers understand this?
So gold is an important hedge in today's economic conditions because, as I mentioned, I think the world is overinvested into dollar assets. It's the most owned asset class. In fact, US total market cap as a percentage of world market cap is at its highest ever, around 65%. It used to be in the 40s and 50% range not so long back. So clearly there is some diversification which is going to happen in the world in terms of how the assets are owned, and therefore gold becomes the natural go-to option, and then the emerging markets, of course. So gold should be part of the core holding, in my view, for the next 2 to 3 years. And whether you do it through multi-asset funds or you do it through gold ETFs, it's a personal choice. But clearly, from a economic perspective, I think gold as an asset class will remain very, very relevant in the next 2 to 3 years. And in addition to that, I think obviously there are geopolitical risks also. So gold is something which can act as a hedge against any such geopolitical risk becoming bigger going forward in future. So both from an economic risk perspective and geopolitical risk perspective, and the fact that the world needs to diversify away from dollar assets a little bit, from all these three angles, I think gold is a pretty important asset class for the next 2 to 3 years.
Rahul, I do have a lot of questions for you, but then my time is up for this particular segment. Thank you so much for taking time out and helping our viewers, navigating the strategies as far as equity portfolio is concerned and the relevance of importance and of gold in their portfolio right now. Thank you so much.